In the course of your investing journey, you may have heard of the term 60/40, a mainstream allocation strategy dictating 60% investment in stocks, 40% going to fixed income or bonds. But our next guest says that a 40/60 strategy is paying off so far this year. Here with more, we've got Todd Schlanger, who is the senior investment strategist over at Vanguard. Todd, good to have you. So explain why you're flipping the 60/40 on its head and how you're implementing the 40/60.
Yeah, well, thanks for having us. The 40/60 is really a reference to our time-varying asset allocation strategies that we run, where we look at our expectations over the next decade for equities, for fixed income, and different parts of the market. And as we look out over the next decade, we see lower returns driven by higher valuations in the equity market and more or less normal rates of return for fixed income. So all else equal, we think investors can achieve a better risk-return trade-off by, underweighting equities, and then even within that, within equities and fixed income, there are parts of the market where our expectations are a little bit better on a risk-adjusted basis, where our strategy is tilted.
And so you explained these time-varying asset allocations. What are some of the misconceptions about this method?
Yeah, so I think the misconception is that it's, let's say, better or worse than something like the classic 60/40. If you're an investor who has a very long horizon, you're not particularly interested in, the current environment because you're a multi-decade saver. We think that static portfolio can be a great option for you. But the time varying really comes in when you're looking at the market and seeing that, hey, there are opportunities out there. There are risks that we can manage. And you want to position your portfolio to try and get that, better risk return trade-off over the next decade.
What is the composition of the Vanguard time varying asset allocation, and what type of rebalancing even do you have to consider with regard to that?
Sure. So we update it on a quarterly basis. You can find it on our website. Actually, we updated it in April, given the volatility. But we're tilted to value over growth, given the run-up we've seen in large growth stocks. Tilted to developed over emerging, given also very strong results in the fourth quarter in EM equity. And then on the fixed income side, we're a little bit longer duration and a little bit tilted to governments over corporates, given our expectation that rates will likely decline, at least at the shorter end, over the coming few years. And so all else equal, we think you could get a little bit better return with that diversification of the longer duration, helping dampen some of the volatility that we're seeing in equities.
My assumption is that the 40/60 strategy would be for someone who's trying to perhaps remove some of the risk from their investment strategy. Is that an accurate assumption, or who would this be for?
Absolutely. So actually, as our most recent update, the returns between, let's say, that classic 60/40 and the 40/60 that I mentioned, they were more or less the same, slightly higher returns for the 40/60. But it's really about the risk and the volatility. So if you look at annualized volatility or the potential for drawdown in portfolio, much more favorable for the 40/60. So it's really about, again, not necessarily just trying to maximize returns, but really managing risk.
Todd, thanks so much for taking the time here with us today.
Thanks for having us.